Welcome to Burns Hustles, where we turn side hustles into cash. Have you ever wondered what the difference between ETFs and mutual funds is? It's a question that puzzles many, especially those taking their first steps into the world of investing. In the vast financial landscape, these two investment vehicles stand out, often leaving beginners scratching their heads. But worry not. In this video, we will demystify these two popular investment options and help you understand which one could be a better fit for your financial goals. Let's begin with ETFs, or exchange-traded funds. Now imagine going to a supermarket and buying a basket of groceries. Each item in that basket represents a different company. With ETFs, you're doing something similar, but instead of groceries, you're buying a basket of stocks, bonds, or other types of investments, all at once. ETFs are created and managed by financial institutions. These institutions choose what goes into the ETF, whether it's a range of stocks from different companies, bonds from various governments, or a mix of other assets. When you buy an ETF, you're buying a piece of this larger basket, and your investment rises and falls with the overall value of the basket. One of the main advantages of ETFs is their flexibility. They can be bought and sold throughout the day at market prices, just like individual stocks. This gives you the ability to respond to market changes in real time. Plus, many ETFs are designed to track well-known indexes such as the S&P 500, which means they often come with lower management fees than actively managed funds. But, like all investments, ETFs come with their own set of risks. The value of an ETF can go down as well as up, depending on the performance of the underlying assets. Also, while ETFs generally offer a wide range of investments, some may focus on a specific sector or region, potentially limiting diversification. Another potential drawback to consider is the trading fee. Since ETFs trade like stocks, you may incur a fee every time you buy or sell shares. These costs can add up, especially if you trade frequently. So to sum up, ETFs are a type of investment fund that can be bought and sold on the stock exchange, much like individual stocks. They offer a convenient way to diversify your portfolio, with the flexibility to adjust your investments as market conditions change. But as with any investment, it's important to understand the risks and costs involved. Now let's move on to mutual funds. Imagine you and your friends pooling money together to take a trip. Each of you puts in a certain amount, and then you collectively decide where to go and what to do. That's somewhat how mutual funds work. They're essentially a pool of money from numerous investors, which is then managed by a professional investment company. This company has a team of financial experts who decide what to do with your pooled money. They could buy stocks, bonds, or a mix of both. They might even venture into other types of assets, like real estate or commodities. This collection of assets, referred to as a portfolio, is then divided into shares that investors can buy. One of the key benefits of mutual funds is diversification. Because your money is spread across various assets, the risk is also spread out. If one stock performs poorly, it doesn't mean your entire investment goes south. There are other assets in the portfolio that could be doing well. In addition, mutual funds are managed by professionals. These are people who eat, sleep, and breathe finance. They have the skills and the knowledge to make informed decisions about where to invest. But of course, like everything else in life, mutual funds have their downsides. One is that they come with fees. These fees are used to pay the fund managers and to cover other administrative costs. Also, mutual funds are typically only bought and sold at the end of a trading day, unlike stocks and ETFs, which can be traded throughout the day. Another potential drawback is that you have less control over your investments. You're trusting the fund manager to make the right decisions on your behalf. If they make a bad call, your investment could suffer. In essence, mutual funds are a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities, which are managed by an investment company. It's like taking a trip with your friends, where you all chip in and trust someone else to handle the itinerary. It might not always go as planned, but it could also lead to some fantastic adventures. Now that we understand what ETFs and mutual funds are, let's compare them. First, let's talk about cost. Generally, ETFs tend to have lower expense ratios compared to mutual funds. An expense ratio is the annual fee that all funds charge their shareholders. It's expressed as a percentage of your investment. So if you have £1,000 in a fund with a 1% expense ratio, you'll pay £10 a year. Because ETFs are passively managed, tracking an index rather than trying to beat the market, they usually come with lower costs. In terms of management, ETFs are typically passively managed, while mutual funds are often actively managed. This means that mutual funds have a team of analysts and portfolio managers making decisions about what securities to buy and sell. On the other hand, ETFs usually track a specific index, like the S&P 500, and aim to mirror its performance. Next, let's consider trading flexibility. ETFs trade like stocks, meaning you can buy and sell them throughout the trading day at fluctuating market prices. Mutual funds, however, have a different structure. They only trade once a day after the market closes, and at the net asset value price. This difference might make ETFs a better fit for investors who prefer more control and flexibility. And finally, we come to tax efficiency. ETFs tend to be more tax efficient than mutual funds due to the way they are structured. When an ETF investor wants to sell, they sell to another investor like a stock trade. This doesn't create a taxable event for the ETF itself. However, when a mutual fund investor wants to sell, the fund itself must sell securities, potentially creating a capital gains tax event for all investors in the fund. As we can see, while ETFs and mutual funds have similarities, they also have distinct differences that can make one more appealing than the other, depending on your investment strategy. Keep in mind that it's not about which is better in a general sense, but rather which is better for you, your financial goals, and your risk tolerance. In the next scene, we'll delve deeper into this topic, so stay tuned. The question then arises, which is better, ETFs or mutual funds? The answer, as you might have guessed, isn't as clear-cut as you'd like. It's a bit like asking whether apples are better than oranges. Both are fruits, sure, but they offer different tastes, different nutritional benefits, and appeal to different palates. The same goes for ETFs and mutual funds. Let's consider a few scenarios. If you're someone who prefers to have a hands-off approach to investing, a mutual fund might be more suited to your style. These funds are managed by professionals who handle all the investment decisions on your behalf. They're a good option for beginner investors or those who don't want to spend time researching and monitoring the market. On the other hand, if you're an investor who wants more control and flexibility, ETFs could be your go-to. ETFs are traded like stocks, allowing you to buy and sell throughout the day at fluctuating prices. They offer the opportunity to be more active and tactical with your investment strategy. Now, let's talk about costs. Generally, ETFs tend to have lower expense ratios compared to mutual funds. However, keep in mind that frequent buying and selling of ETFs can rack up brokerage fees, which could eat into your returns. Risk tolerance is another crucial factor. Both ETFs and mutual funds spread investments across a variety of assets, which can help reduce risk. However, the level of risk can vary depending on the specific ETF or mutual fund you choose. As for the investment horizon, if you're planning to invest for the long term, mutual funds might be a better fit due to their systematic investment plans. But if you're looking for short-term investment opportunities, you might find more flexibility with ETFs. Remember, there's no one-size-fits-all solution here. Whether you lean towards ETFs or mutual funds depends on your personal investment goals, your risk appetite, and how hands-on you want to be with your investments. So, the choice between ETFs and mutual funds ultimately comes down to your personal investment goals and circumstances. To wrap up, let's take a quick stroll down memory lane. We've delved into the world of exchange-traded funds, or ETFs, and mutual funds, unraveling their intricate details. We learned that ETFs offer flexibility with their ability to be traded like stocks throughout the day, and their typically lower expense ratios. On the flip side, mutual funds offer a different kind of allure. They provide professional management and a more hands-off approach, making them an ideal choice for those who prefer a more passive investment style. However, the golden nugget of wisdom here is this: there's no one-size-fits-all answer. Whether ETFs or mutual funds will serve you best depends on your individual circumstances, your financial goals, and your risk tolerance. So, it's all about understanding these investment vehicles, weighing their pros and cons, and aligning them with your personal financial landscape. Remember, understanding your investment options is the first step towards making informed investment decisions. So, keep learning and start investing.